Hello, everyone. I'm Ted Oakley, managing partner here at Oxbow, and it is my pleasure today to interview Grant Williams, and someone that nobody really needs much introduction to. He's been around for 35 years. He's been in all the 7 major cities across the world, really, including New York, Sydney, London. Knows a lot about finance. He's interviewed more people than anybody I know, and he has a great site that I'd recommend to you, things that go, And Grant, we're certainly glad to have you today.
Well, Ted, thanks for having me. This is a real pleasure. Thank you.
You know, you're usually doing a lot of the interviewing, and you're a fabulous interviewer, by the way. And so it's, and I know you have a lot of great thoughts. You've been around that long, you've been around a lot of firms, and you co-founded Real Vision. And so we're going to be happy to find your thoughts today as well.
Well, I'm delighted to share them with you. It's always good to chat and share ideas about these things because it's such a confusing time right now, and I think the more people you can chat through ideas with and try and come away with either confirmation or challenges to your own thoughts, it's just so important to do.
We're going to be using a few slides today, but a couple that I wanted to start out by asking was if you look at the current account deficit and the trade deficit, which are both continuing to sink. And our deficit of the U.S. government here, where do you think that ends, or at least subsides, or something?
Well, it's so interesting. If you look at that chart at any other point in either your life or mine, we all know what this would lead to. It would be an absolute catastrophe, and the dollar would disappear, basically. But you've got this weird situation now with the pandemic that everybody's doing the same thing, essentially. And so the dollar is still, the cleanest dirty shirt, as the old saw goes. It's a lot dirtier than it was a couple of years ago, and it's going nowhere near the washing machine anytime soon. But I don't see this ending. I mean, I think they will push more stimulus. I think we have this bizarre situation where the economy is quote unquote firing on all cylinders, judging by some of the metrics that we're seeing, some of the data points coming through. But I think the administration realizes that beneath that, there are some major structural issues, which the pandemic has revealed. And so we're in this really between a rock and a hard place where the economy, despite some of the headline data, can't really stand on its own 2 feet. And yet, given the state of the deficits, to continue to buy $120 billion of bonds every month by the Fed is incredibly reckless. To pump out another couple of trillion in additional stimulus is incredibly reckless. But it feels as though right now, the dollar, which would normally be the place that would pay the price for this, is going to get a pass for the time being. The question is, I think, and I'm sure we'll get onto this, this now comes down to this question about, is inflation returning? Because if inflation does return, then this becomes a problem very, very quickly. And if, as the likes of David Rosenberg and Lacey Hunt, to quote 2 prominent examples, are correct, and we still are facing a deflationary problem, then this may continue for a little while longer.
And that brings me to this. We have a couple of pictures here, slides on interest rates. I mean, one on the 10-year, and I have to say, Grant, we feel like since 2008 or 9 that the Federal Reserve has done tremendous damage, really, to the country by not letting us go through cycles. That's an Oxbow opinion. But where do you see these people going? I mean, as we show these interest rates, they back up a little bit, talking about inflation, and I'm not certain, honestly, they have a clue about what's going on.
Ted, for the longest time I've debated in my own mind, are the Federal Reserve, and look, let's not confine it to the Federal Reserve, let's include the ECB and the Bank of Japan and even the Bank of England in that. Are they being disingenuous in terms of how they communicate to the public what they're doing and why they're doing, and the fact that they see for example, no connections between Fed policy and wealth inequality? Or are they clueless, as you just posited? And I've decided it doesn't really matter. There's no right answer, and neither is better than the other. Whichever it is, it's a problem. And I think you're absolutely right. I think they've done tremendous damage. But I think the point we've reached right now is they are now trapped by their own hubris. They're trapped by the actions they've taken. And so at this point, it doesn't become about what's the right thing to do for the system. It's now what's the right thing to do to stop the damage we've done, either revealing itself or causing major problems in the global financial system. And so for investors, I think that shift actually makes it slightly easier for us, perhaps, because if we look at every decision they're going to make through that lens, what do we have to do here to keep things together? It becomes much simpler to kind of figure out the path they're going to take. This is why I think inflation is such a key problem, because if inflation does come back meaningfully and it isn't transitory, as we keep being told, then what they have to do to keep the system together becomes the very thing that will kind of reveal the problems they've caused over these years. That's why I think it's such an important thing.
And one of these graphs we have here shows how the bond market, in the face of that, from say 6 or 7 years out, those have moved higher from an interest rate standpoint. And it's almost like they're saying, well, we think a little differently than the Fed thinks. And I suppose, like you say, that there's two sides of this argument on inflation. And I was wondering, maybe some point in time you might have both. You've inflated in the short term and it throws you into a recession, and you have to come back around and do what Lacey and David are thinking. But with that, one of the things that's really inflated a lot, and I know one of the things about you is you're really familiar with the world. You've lived in New York and Sydney and London and in the Caymans. You've been a lot of places, and you've been with a lot of different kinds of investment firms. But if you see anything, if you look at this interest rate thing with the Fed and everything, and you look at what's happening, I'm going to put up a few things here on real estate. Have you ever seen anything so quick, so high as in residential real estate?
Yeah, it's amazing, and this is a global problem. If you think just how important the supply of easy and cheap credit is to the housing markets. And this is something we've seen all over the world. You mentioned that I lived in Sydney, and I lived there for a number of years, and the housing market there would make even Americans just unable to comprehend what's going on. But I think the trouble is there is so much wealth now tied up in the value of people's houses, and we've had a kind of glimpse into what happens to the world when we have a coordinated real estate bust. Remember Bernanke saying that we've never had a nationwide housing bust. Well, we had one. We got a glimpse of it, and don't forget that the cost to ameliorate that in the short term was $787 billion, which they threw at this thing through TARP. I mean, that's 6 months of QE now, to say nothing of the stimulus, to say nothing of what it would cost to kind of stop another housing price fall. So central banks again have become really the protectors of housing markets now. It's another one of their silent mandates. In fact, in New Zealand, the central bank has actually taken the housing market on as one of its key criteria, as one of its mandates. So, there's no real way to gently disinflate a housing bubble, unfortunately. They tend to be dramatic, and they tend to be catastrophic. And what we've seen with the buildup of leverage in the system, and I say that supply of cheap credit is really the fuel for the housing bubbles worldwide, is really, so you can see how this whole thing is tied together. If inflation comes back and rates have to go higher, that's going to cripple the housing markets around the world. So that's where all this meets. The housing bubble, the stock market bubble, the credit market bubble, all of this meets at the point where rates have to go up. It's not a case of a choice, but they have to go up.
And I think people forget, Grant, that if you live in the U.S., for example, and let's say in the last 1 year, the median sales price is up about 40%. But let's just say that it keeps on going. And, most states, everywhere they have taxes, city, county, state. And I was telling somebody the other day, I said, what if you're a first-time home buyer, you go in, you can barely make the payment, you can make it, but you've got insurance, which also goes up with the value, and then you have taxes that go up a lot with the value. Then the incoming buyer you're going to sell to, is going to have a tough time because all of a sudden their payment's higher. There's some point in here where it affects the marketplace, and that's interesting. And I did include a graph that showed the stock market and real estate. While they're not 100% correlated, they're fairly highly correlated. When the markets are doing well, real estate's done fairly well too. And so what you're saying is putting on all together, all three of those that you just mentioned, those bubbles, they come together. And so one of the things I put in there too, I wanted you to look at is there's an interesting phenomenon going on here. If you look at $1 million homes and higher in the U.S., I don't have the world figures, but in the U.S., they're up like 200% in a 12-month period. And we included that in here. But do you see obviously there's been this uneven wealth effect from the Fed. I think you've mentioned that before. And you can certainly see it in this, where they're paying really huge prices for these big homes. You see that inequality moving forward the same?
Yeah, Ted, this is it's such a great table that you put up there. When you see even in the Northeast, where we know there were so many $1 million plus homes, even the Northeast is up 127%, which is extraordinary. But to your point, I think that because of the availability of cheap credit, people are stretching themselves to buy these homes. It's creating competition, and it is pushing the prices up. But the only thing, as you quite rightly pointed out, that hasn't gone up in terms of the cost of owning a home is the mortgage payment. And that's a problem because insurance is going up way faster than the CPI, as you know. Taxes are necessarily going to go up. So I think what we're seeing now is the kind of last fumes of people stretching to buy a home they really can't afford, but they can get the credit to do it. And we're already starting to see some data come through in the housing market that suggest that sales are starting to fall off. And so I do wonder, and I've just spent some time in the UK with my daughter and my grandkids, and they're buying their first home. And so I've seen that process in the UK. There's been a stamp duty holiday in the UK since coronavirus began. And so they're in this last month of trying to get a whole bunch of purchases through to take advantage of the stamp duty holiday. What happens when that finishes? One would imagine that immediately the price of homes correct to reflect the fact that everyone's going to have to pay stamp duty. So you're going to instantly see, close to a 10% fall in house prices just because people now have to take that out of their closing costs. So it's just another sign of the importance of the continued availability of cheap credit, and another sign that if rates start going up, anyone that has an adjustable rate mortgage, as you quite rightly pointed out, is going to very quickly find it difficult to meet the new payments. And that's, again, there's no other way to say this, but this has to be laid at the feet of central bankers.
And speaking about that, we have a slide here on commodity prices versus the S&P 500. People tend to think about things the way it's been the last 10 or 12 years. And so it's very hard to get into their mindset. Now, you and I have been around long enough to see this stuff, fortunately or unfortunately. But the main point is that if you look at this graph, commodities relative to the S&P 500, commodities could possibly have a long way to go on the upside.
Yeah, and that's a great chart. But if you take that chart back further, you can take that chart back 100 years, and you'll see that we are at a 100-year low, not a 30-year low as in this chart. And your point is absolutely right. Humans have a great ability to kind of extrapolate recent trends, and the fact that we haven't really seen any inflationary pressure of any meaningful duration or any meaningful level since the 1970s means, of course, that most people around and active in markets today weren't around or weren't certainly old enough to remember what that felt like. And I think more importantly, Ted, how quickly it happened. And that's the part of this that I think people forget. If you go back and look at the great inflations of the past, there are two books that I kind of talk about every time the subject comes up. One is called The Dying of Money by a gentleman called Jens O. Parsons. That's Parsons.
I've read it, 1974.
There you go. And the other one is When Money Dies by Adam Ferguson. And both of those are tremendous accounts of of great hyperinflations of the past. And when you read them, two things I think stand out. One is the similarities between the periods leading up to those periods and today. But the second thing is you realize how quickly inflation gets out of hand. And to be clear, I'm not predicting we get hyperinflation in the US or Europe, for example. But inflation can go from 1-2% to 7-8% quicker than you can believe when it really starts to take hold. And if that happens, we don't even need to get 8% inflation. If we have 5% inflation, we've got some real problems here, not just in the US, but right around the developed world.
It's interesting too, Grant. I tell everybody, because that book's hard to find, The Dying of Money. But if you read the first 5 chapters, it's almost all you have to read on Weimar Germany and how they went from standing still, I guess, in 1918 to 1923. It's amazing what happened there.
Yeah, Ted, if you go to the von Mises Institute online, they have a PDF of the book. So I'll send you a link to that, because I think if you share that with people, as you say, it's such an important thing to read and understand.
Thank you for doing that, and we'll send that on as well. But so I'm going to shift emphasis here, and I do have a couple of graphs on the multiple of the stock market, and obviously the Buffett indicator. And I don't want to necessarily. Everybody sees those all the time, and I don't want to necessarily go into detail on this because everybody knows that, and I think people have heard that prices are so high, various things. But I do have this question for you. There seems to be an idea out there that nothing can go wrong, that we're in this situation where things will be good forever. What are you worried about? And why do you care what you pay for something? It's going to go up. What is that, Grant? What's going on there?
Well, again, I think the books that we just referred to again offer such an important glimpse into the psychology, because if you go back to immediately before that hyperinflation, you can get a glimpse into people's mindsets, and it was very much the same. We can't have inflation. Inflation's not coming here. We don't need to worry about inflation. I think there are a lot more people who remember 2000. Thankfully, certainly more than remember the 1970s, and again going back to 2000 in the technology bubble, if you were paying attention at the time, you do remember that feeling that, well, what can go wrong? The internet is going to be here forever, and the internet is a one-way ticket. And look, the internet will be here forever, and it is a one-way ticket over time. But that's not to say that things can't get stretched in the short term, and that's really what's happened here. It was the bust of the .com bubble that led to all the assets being sold off for pennies on the dollar, and which led to people being able to buy up fiber optic cable companies and buy up the existing infrastructure and offer internet to the world for $9.99 a month. So without that bust in the business cycle, which is inevitable when things get to these kind of extended valuations, you don't have the kind of creative destruction that Schumpeter talked about that enables these long-term trends like the internet and like technology to take root and to do so at an affordable price. So there is nothing new under the sun, as my friend Simon Mikhailovich likes to say. We're there again, and the mindset is the same. What can go wrong? This is a one-way ticket, but unfortunately, like every other one-way ticket, like every other period in time where humans have thought what could go wrong, something will, and it will be a painful lesson for people to learn. It's just the way of the world, unfortunately. And Grant, back in 1998-99, I had a lot of people that had just come into the market tell me that, hey, it's a new paradigm, Ted. You don't realize that you're lost. You're lost in the old numbers. And of course, you know what happened afterwards. Now, if you take the millennials and the Zoomers and everything, they're the same. They're like, wait a minute, man. You're not understanding what's going on here, and we're going to talk about that in a bit. But it's interesting, the same thing. And there's a piece that I actually put together that there's a graph there that shows, and I don't think people understand this. They figured it out in the 2000 bear market. But if you could 12% compound for 5 years, or 15% compound, both great numbers for 5 years, and when you roll into that 6 year and have a 50% decline, you're either back where you started or you're underwater, and nobody understands that. Yeah. Again, it's down to experience. If you've looked at history, and if you've read history and you understand history, then you have a great advantage over the people who don't. And if we go back to the Great Depression, and again, look, people will say, oh, it's an easy go back to Great Depression, but let's forget the Depression itself. Let's take the damage it did to stock markets as the starting point. And we look back to the Dow Jones. It took 25 years for the Dow Jones to get back to its 1929 levels. 25 years. Now, people can't believe that kind of thing. Since 2008, the big drawdown we had in 2008, it took a couple of years to get back, thanks to all the stimulus being thrown at the market. And so this buy the dip mentality has been fostered during that period, that anytime the market's down a little bit, you buy it and it's always going to go up. But when you have those real drawdowns, and the kind of drawdown that you get when there is a much bigger problem, which the return of inflation would certainly be, then it's not a buy the dip opportunity. It can lead, as this fantastic table shows, it can lead you to the kind of losses that, depending on your age, you don't have time to recover from. And that's potentially a real problem, and people need to understand that.
Well, and that leads me to this. I don't put anything past Wall Street that they can't dream up to sell. And one of the graphs I have here is on the special purpose acquisition corps that have been issued. At Oxbow, we're not fans of those. We don't think that's a fair trade. And I would be curious, though, to what your thoughts are on this. Because obviously, if you remember back in the early 80s, maybe late 70s, they outlawed blind pools. But now they figured out how to repackage it, put a bow on it, and bring it out again. What do you think about that?
It's so true, and I think you hit the nail on the head with the very first thing you said there about Wall Street never struggling to come up with ways to sell things to people. And I think what we're seeing here with the SPACs, and interestingly enough, if you look at the SPACs, almost half of them are underwater now for those that 2020 vintage, and even the ones for this year. And so when you look at this, you realize that what's happening in the markets here is a desire to try and sell stock to less experienced individuals. We've seen a slew of at-the-market offerings by companies. Extremely what a professional investor would look at and call an extremely overvalued company are doing billions of dollars in at-the-market offerings, which for people that don't understand them means essentially that institutional investors wouldn't touch it with a barge pole, but we can sell these things to retail investors. And that's what's been happening. This kind of sudden interest in the stock market from retail investors, which again we saw at the peak of 2000. We saw retail investors flooding into the markets, really not understanding the mechanics of the market, and ultimately losing an awful lot of money. We're seeing that again here. At this time, it's been amplified by social media. There's been a lot more coverage of it because of the ease of sharing videos of influencers talking about shares and talking about prices, and of course we've got trillions of dollars in stimulus checks floating around with people who are sat at home and looking for something to do, and this kind of gambling mentality in the stock market has driven this kind of thing. But what the slew of SPACs tells me is we are running out of people who will pay these lofty valuations for our companies, and the last people left standing are the retail investors. So I think, again, it's a clear sign. If you've been through a couple of cycles before, you recognize these signs and what they mean. And they don't ring a bell. They don't necessarily mean, okay, as soon as the SPAC thing starts to go under, that's the end. But these things all tend to happen around the top of a market. And so I think people need to be aware of that and need to be paying attention to things like this and understand what they mean in the broader sense, in the historical context.
That's interesting, too. On the retail or individual investor, I've always known this over my career. At the tops, a lot of closed-end funds come out, and because retail buys them, and they've been pushing them out like crazy over the last 5 or 6 months. But pushing to another subject right here, talking about that, this graph that's going to come up is on cryptocurrency. And that valuation, these are the top 300. Now, this graph is a few weeks old, so it doesn't include what happened in the last week and a half or so. But at Oxbow, we do not own crypto. And one of the things that we have gotten pressure on from, obviously, people under 35 is you're living in the wrong world. But there's an interesting op-ed today in the Wall Street Journal that talks about, and what that person said is, look, if you want to get rid of, it's about ransomware, but
Sorry, yeah, sorry.
Yeah, but the main point is that the bottom line on is what good do cryptocurrencies really do other than go up in price? And so I'd be curious of what you think about cryptocurrency.
Yeah, look, I try and stay away from it, sadly, because it's become such a toxic environment to discuss cryptocurrencies. But I think it's important to distinguish between cryptocurrencies and the blockchain. You know, blockchain, the distributed ledger technology is here to stay, period. That's not going to go anywhere. But what we've seen again, and it comes back to that kind of gambling mentality that's kind of infused itself through retail investors, cryptocurrencies have become pure speculation. And right now I include Bitcoin in that. It's pure speculation. I understand the long-term case for it. I have many concerns about that, which would preclude me from piling into cryptocurrencies, and just the wanton nature of the volatility and the pure speculatory aspect of cryptocurrencies mean I have no interest in them. But what's been fascinating to watch is that people don't like you not being involved in cryptocurrencies. It's perfectly acceptable to say, you know, I understand them, but it's just not suitable for me, and that's where I stand. I still worry about regulation for cryptocurrencies. I still think that's coming. I still think all this talk about, you know, you can't shut cryptocurrencies down because it's distributed and no government can shut it down, I think is missing the point. And the recent volatility based on a couple of tweets from Elon Musk and some headlines out of China are enough for me to believe that my concerns are well founded. And so I don't want to own an asset at the age of 54 that is this volatile and can lead to, you know, 50% drawdowns in a week. It's just not a suitable asset for me. I understand the promise of blockchain technology, and I feel it will fulfill that promise, but perhaps not in its present form.
Well, and I think most people don't understand blockchain technology, but if you think about it, it's just a new way of security and a medium of pipeline in a way. And I think that is where it will really be important, over the next few decades. But that's separate and apart from cryptocurrency.
Yeah,
I mean,
that's
a different thing. But on that same line, and the last slide I've used here was on gold. We're owners of gold in a few of our strategies as well. I'd be curious of what your opinion is on gold long term.
Look, I've been interested in gold since about 2000. I bought my first gold in around 2000, purely as a hedge against what I thought was going to happen in terms of monetary debasement, and that has played out. Gold's a very interesting asset. It's a very emotional asset. It doesn't have any cash flows. It doesn't have a business. You can't really evaluate it on anything other than emotion, realistically speaking. And so, again, like cryptocurrencies, it has this emotional volatility attached to it, which can be problematic in the short term. But I think if you're a short-term investor in gold, then perhaps you're merely using it as a vehicle to represent a view in something else, which is absolutely fine. But I think if you want to own gold, you want to own gold for the long term, and you want to own it for the protection it offers your portfolio against things like inflation, against things like monetary debasement, against pernicious central bank policy. And if you look at it, it's done that remarkably well since 2000. You know, it's outperformed the S&P since 2000. All you had to do was buy gold and hold it over that period, and you've outperformed all the stress and the strains of owning equities. And yes, you'd miss out on the euphoria of the kind of 2005, 2006 run, and you miss out on the recent euphoria, but you could have slept every night and not had to look at markets every day. So I think gold provides great utility as a reserve asset as opposed to cash. I think it provides a great hedge against all kinds of things that are problematic for portfolios. And I think in the current environment, given where the likely path of central bank policy is going to be, gold offers something that many people will argue cryptocurrencies do. And in the short term, they have. But the likes of seeing a 50% drawdown in gold in a week, I put as close to zero as one can meaningly put something while being realistic that nothing's off the table. And so for me, I much prefer owning gold to owning cryptocurrencies. I know I'm not going to get 3,000% returns in a short period of time, but I also know that my purchasing power is going to be largely protected over a longer period of time. And that for me is far more important.
And you know, Grant, one of the things, it's interesting because, you know, you can always touch and feel and grab gold. And it's interesting about the cryptocurrencies. Reminds me a little bit of the tulip bubble when everybody, you're the great historian, but everybody bought the tulips. And it seems like one day they looked up and said, you know, well, these are just tulips. And then maybe, I think that a lot about cryptocurrency, and sometimes, unlike gold, cryptocurrency, maybe they look up someday and just say, well, wait a minute, this is just an entry.
Look, I think we're seeing that already in some of these, you know, kind of pure speculative coins. You know, we're seeing wild volatility swings. We still haven't seen, you know, we've seen this Dogecoin still has multiple billions of dollars of market cap, and the guys who created that, and if you've seen videos, and there are videos on the internet that I would recommend people watch of how to create a cryptocurrency, you will see it takes 5 minutes to do with a few clicks of the mouse, and suddenly these things have billions of dollars of values. And the creators of Dogecoin said, we created this as a joke, and yet that joke now has $50 billion of market cap. Now, if you believe that that is going to continue, then by all means own some. But if the last couple of weeks haven't shown you a couple of things: one, there is tremendous volatility in cryptocurrencies, and two, if we are seeing in the broader market a swing back to value over growth, which I think is undeniable at this point. If you look at that, you can see that happening. Then if the world is moving back towards value, a value orientation, and wanting to own things that have some kind of value, then what does that say for the future of a currency that was created out of thin air as a joke and the $50 billion of market cap that it has? To me, there's a clear red flag there.
Well, Grant, I have one more question for you that I've never asked anybody in an interview, and I think with your knowledge of the world and the things that go on in the world, and particularly the future of what's happening, I'm going to ask you a question. You know, a number of years ago, you could sit down with someone that's a good friend or a family member, and you could disagree with them. You could have a social disagreement and still be great friends and that sort of thing. It seems like we've gotten this all to a place to where, and I think it's sort of shaking people up, you know, just in general about. I'm not certain about the world right now. How do you? I know it's a big question, but how do you feel about that?
Ted, you know, it is a big question, and it's something I spend so much time thinking about, and it concerns me greatly. You know, I think this is one of the biggest existential threats that we face today is the loss of the ability to disagree respectfully with people and to debate ideas from polar opposites of any spectrum, whether it's political, financial, geographic, whatever it may be. And you're right. You know, there was a time when you could do this. You could disagree respectfully. And I'm thankful that I have a number of friends in my life that I can still do that with, and we can debate politics, and we can debate cryptocurrencies, and we can debate markets. We can disagree strenuously, but at the end of the day, there's a respect for a thought process behind the other person's views and beliefs. And while you may disagree with them, they're not flip views. They're convictions that the other person holds. And unless we can get back to that, unless we can get back to the idea that it's healthy to disagree with people, and it's healthy to air those disagreements and try and understand the nature of them and whether we are wrong and maybe the other person has a point, it causes me tremendous concern, I have to say. And it's not, you know, it's easy to get kind of gloomy about this. But I think as a societal problem, this is evident right around the world. It's no worse in America than it is in the UK. It's no worse in the UK than it is in France. And unless we can find a way to regain that middle ground, regain that ability to have healthy disagreements, I think it's a road that really we don't want to travel down too much further.
Well, you know, Grant, I want to thank you. We could sit here and talk to you for hours. I know you have a lot of great information that people would like to hear. But for everyone out there that doesn't know, you'll see at the bottom of this where you can take Grant services. I would highly recommend it, the podcast or the newsletter. I think you'll find it to be really interesting. But Grant, I want to thank you. Thank you for taking the time to visit with us, and we certainly hope to see you back again sometime.
Ted, anytime. I've thoroughly enjoyed the conversation, and the very best of luck to you.
Thanks a lot.